Wall Street is facing a structural valuation dilemma, a fundamental re-evaluation that could redefine how we price the next generation of market leaders. It's a paradox. Why do sophisticated investors consistently overlook massive losses in companies like SpaceX and OpenAI? The answer isn't simple, and it signals a coming storm for public markets. This isn't just about high-growth tech, it's about a new breed of structural innovators. Companies like OpenAI are not selling quarterly profits, they're selling the future of intelligence itself. SpaceX isn't just building rockets, it's laying the foundation for an interplanetary economy. Their core moat isn't traditional market share, it's technological singularity and first-mover advantage. Their value proposition is clear: disrupt existing industries, create entirely new ones, and capture winner-take-all markets. This strategy demands massive upfront capital investment, making traditional profitability metrics almost irrelevant in the early stages. It's an asset-heavy, long-duration bet on the very fabric of our technological future. Now, let's talk about those losses. What public markets traditionally label as red ink, institutional capital often sees as strategic reinvestment. These aren't losses from operational inefficiency, they're capital expenditures on R&D, infrastructure, and talent that drive future exponential growth. We're talking about billions poured into data centers, rocket facilities, and cutting-edge algorithms. This matters because the market appears to be pricing in a different kind of earnings visibility. It's not about next quarter's EPS, it's about a multi-year hockey stick revenue curve and eventual margin expansion from scale. Think about early Amazon, AMZN, or Tesla, TSLA, where profitability was a distant promise, overshadowed by immense growth potential. The implied management strategy from these firms is aggressive capital allocation towards absolute market leadership. Their execution strategy isn't about appeasing quarterly analyst estimates, it's about securing a dominant, perhaps monopolistic, position in nascent, trillion-dollar industries. They're building infrastructure that will redefine economic gravity. This philosophy sets them apart from traditional public companies. They are essentially operating with a private equity mindset, taking calculated, long-term risks that would send most public market boards into a tailspin. The capital deployed is a bet on an entirely new paradigm, not incremental improvements. The industry context is critical here. We're witnessing a rapid acceleration in both AI and the space economy. AI, powered by firms like NVIDIA, NVDA, and giants like Alphabet, GOOGL, and Microsoft, MSFT, is moving beyond theoretical to practical application at warp speed. Space is transitioning from government projects to a commercial frontier, creating entirely new supply chains and demand recovery. This macro environment provides significant sector tailwinds, but also intensifies the competitive landscape. These companies aren't just competing with each other, they're setting the pace for established players. The sheer scale of capital required means only a few will truly dominate, making the growth at any cost strategy a necessary evil for future supremacy. But that leads us to the critical risks. The most obvious is the long pathway to profitability. These companies burn cash at an unprecedented rate. Then there's regulatory pressure, especially for AI, which could stifle innovation or impose unforeseen costs. What if the technological bets don't pay off? What if a competitor truly leapfrogs their advancements? The systemic headwind is how public markets will actually price these entities upon their eventual IPO. Wall Street, often fixated on quarterly results, may struggle to adapt to these new valuation paradigms. Think about Brian Sotz's conversations with Stephanie Guild at Robinhood, HOOD. It highlights the chasm between traditional analyst models and this disruptive capital deployment. There's a risk repricing coming. So, what's the outlook? We expect a significant valuation reassessment across the broader market. The public debut of these next-gen AI and space leaders will force a new dialogue around growth metrics, total addressable market, and the long-term compounding effects of technological leadership. This isn't just about a stock offering, it's about a new investment thesis for the digital frontier. For investors, this means identifying companies with true structural momentum, not just fleeting trends. Look for leadership in core technologies, immense R&D budgets, and a clear path to market domination, even if profitability remains years away. This multi-year thesis demands patience and a willingness to look beyond conventional wisdom. The NASDAQ will become the primary arbiter of this new paradigm. On our breakout watch, we're tracking firms enabling this next generation, like NVIDIA, whose silicon powers much of the AI revolution, and others with deep capital deployment for future market share. Conversely, trim consideration applies to established firms clinging to outdated valuation models or lacking the agility to adapt to this structural shift. It's about capital rotation into tomorrow's winners. The landscape is changing rapidly, and staying ahead requires deep institutional analysis. Don't miss our next deep dive into these structural shifts and how they impact your portfolio. Make sure you hit subscribe, turn on notifications, and join the SRMoneynews community for exclusive insights into the markets shaping our future. Your capital deserves the best intelligence.